Time now for an in-depth look at the market news on this Friday, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Dr. Kim, thank you for coming on today.
Good afternoon, Devin.
Good afternoon. Well, the People's Bank of China on Monday lowered its short-term funding rate for the first time in 4 years. Then it cut another key rate on Wednesday, trying to shore up growth. Tell us about that and what effect it's had on the markets.
This year's Chinese economy is experiencing declining more than expected due to quite a few structural problems in China. For stimulating economic growth, Chinese central bank decreased prime rate by 0.05% on last Tuesday. But this is not enough interest adjustment for providing a significant impact on Chinese economy. Interestingly, the tiny interest cut of this time shows complicated situation in Chinese economy today. Actually, they wanted to decrease interest rate in a larger scale, like 1%, but lower interest rate causes another negative problems in China, like higher inflation and bubbles in housing market. So the episode of tiny interest cut by Chinese central bank represents complicated Chinese economic situation.
The cut was like 5 basis points. Is
right.
That correct? Yes. Right. Now, meanwhile, the protests in Hong Kong have resulted in the worst quarter for Hong Kong in 40 years. The city, of course, a major destination for Korean exports. So what direct or indirect effects might this have on the Korean economy?
Hong Kong's economic growth in third quarter decreased by 3.2% compared to previous quarter because of ongoing political instability. This is a natural economic outcome because Hong Kong's economy is highly dependent on service industry like sightseeing and restaurants and so on. Hong Kong is actually Korea's the fourth largest export partner, which covers about 7% of Korea's total export. But the export to Hong Kong is an intermediary export, which goes ultimately to mainland China. So I believe that as far as Hong Kong's harbor facilities are working, there won't be serious effects on Korean economy.
Well, Hong Kong is, of course, now a variable in the trade war situation. The U.S. Congress passing a bill in support of the protesters, which China has reacted to angrily. This uncertainty has also hit Korean stocks. So what's the situation there?
The phase one U.S.-China trade deal is continuously delayed because of U.S. dissatisfaction on China's U.S. agricultural product import. And Hong Kong's political instability gives another negative impact on completing the deal between the two countries. Since Korea is highly dependent on both of the countries, Korean stock market will experiencing larger and more frequent ups and downs until the deal is finalized.
It certainly has lagged behind this year. Now, estimates of global GDP growth for this year keep getting lower, and we saw an estimate this week putting global debt at a record of more than $250 trillion. Why has debt jumped like that, and what does a figure like $250 trillion mean in a global context?
The large debt problem in global economy is, I think, possibly the most destructive threat to the future of global economy. The debt has been generated all over the world after global economic crisis of 2008 and the counteract policies of quantitative easing. The $244 trillion of global debt is actually 3 times larger than global GDP. So if each central bank increases interest rate faster, there is a possibility of wave of bankruptcies, which goes to another financial crisis all over the world.
Indeed. Well, Korea's debt, of course, is growing too, with things like next year's super budget. Does this, as some say, affect Korea's basic fiscal soundness?
Compared to other major economies, Korea's strength is on healthy government debt structure, which is 40% of the total GDP. Actually, this is much lower than other G20 members' government debt size, like U.S. 160% of the GDP and Japan's 210% of our GDP. So broadly speaking, Korea has an advantage over implementing expansionary and aggressive fiscal policy, but too fast increase of the debt should be avoided because if we increase government debt at the speed of next year, the size of the government debt could be uncontrollable in the next 10 years.
Got it. All right, Dr. Kim, we appreciate you coming on today. We always appreciate your insights.
Thank you very much.